Let me now bring on board Sanjeev Prasad, Managing Director and Co-Head of Kotak Institutional Equities. Sanjeev, good morning. Thank you for joining us. Let's start with the market view. 3 months ago, everybody was worried about election outcome, what Fed would do. But frankly, right now, there are just no concerns on the horizon. Everyone is convinced about election outcome. Everyone is convinced about earnings, and everyone is convinced about the flows. I mean, rarely do you see a situation where there are no concerns in the market.
It's a good position to be in, right? And I hope, no concern stems up, from unexpected sources. So as you rightly said, yeah, I mean, as of now, everything looks good for India. Macroeconomic situation is pretty decent. The growth is looking fairly strong, despite some persistent weakness on the consumption side. And the global rate cycle cut will probably start sometime soon, even though that expectation keeps getting postponed by, every month as we go along. But at some point in time, given the fact that inflation and more important, core inflation seems to be, coming down in most of the developed world, I would assume the US Fed will start cutting rates at some point in time. Yeah, and on politics or any other, front, doesn't look like there is any concern for now.
Okay, point taken. Hi, Sanjeev. Anisha also joining in the conversation. I was just going through your note on PSU. You are saying that it's perhaps the low float and the high amount of perception change that has happened there, but it's not backed by earnings. And over the next 12 months as well, you're not expecting any earnings improvement there. So what's the call on PSUs?
Somewhat selective now, given the broad-based rally that you have seen in PSUs, irrespective of the sector. And keep in mind the fact not as if things have changed dramatically for certain sectors. If you look at the positives side, clearly there have been some, or I would say, decent improvement as far as the investment part is concerned, and that's applicable for both the private household as also the public sector capex part. So no issues on that part of the story. Things are looking pretty good. But obviously, stocks are up a lot in anticipation of a fairly strong, government capex cycle. So let's see whether that sustains, how long, all that stuff we'll have to wait and see. But beyond that, I'm not too sure because we have seen rally in so many of the PSU names without any real change in fundamentals. So I don't know, what the reasons over there. Some of it, as we have tried to figure out, could be just because of, change in narrative, change in expectations. So it's not very visible as of now. Or simply, very, very little free float in many of the cases, so I don't know. I will leave it to the investors who are finding value in some of the names, but honestly, we are struggling to find value in many of the PSU names at this point in time.
The other thing that really stood out, Sanjeev, in your India strategy note was that you believe that most sectors and stocks are quite overvalued. So is the tactical call then to take chips off the table and protect your gains?
I assume so, or you move to the large caps, or defensive sectors where, the chances of, let's say, a big correction seem to be on the lower side. See, keep in mind the fact that we're not making any sort of call that, India will see a big market correction, anyway, as I keep saying, and I am not in the business of forecasting, prices. They will do what they will. And as we discussed earlier, things are actually pretty decent as far as the broader setup is concerned. So I don't see the reason why suddenly you see a big correction in the market. There's nothing on the angle which suggests so. But the fact remains that stocks are overvalued. I don't think there is any, debate or dispute about that. Barring the financial sector, banks and BFCs, insurance, most of the sectors seem to be pretty overvalued. And when I say overvalued, you either look at in the context of, comparison with historical multiples, let's say pre-COVID time frame, FY17 to FY19 may be a good time to look at. And especially in the context of the fact that incrementally the operating environment for many sectors will probably become worse only, given the fact that you are seeing a lot of disruption challenges, not many changes to the operating environment sectors in the form of new competition coming in, business models becoming weaker, business modes getting eroded slowly. So in that context, I'm just struggling to understand why the market wants to give higher multiples for sectors and stocks where incrementally, the challenges are becoming more and more, clear. Look at something like an Asian Paints, an example. Fantastic company, but it's still trading at the same valuation which we used to trade before the pandemic, roughly, 50 times on a forward basis. Maybe the market structure is changing to a negative, more competition coming in. Only time will tell, how Asian Paints manages to weather the storm. But clearly, the market is not assuming any real change as far as Asian Paints operating environment is concerned, which I just find a bit strange. Only time will tell what will exactly happen. But the point remains that somewhere investors are not even taking cognizance of the risks which are out there.
What is the risk out there? Let's understand. You cannot discuss something which we don't know, but out of the known factors, what is the risk?
Say, it's not as if on fine day people. I mean, okay, let's look at the biggest concern is obviously valuation. But having said that, that's been a relevant point for the last 12 months now. Things have become more and more overvalued over a period of time. And the more important thing is the extent of overvaluation keeps on increasing as we go down the market capitalization curve, the quality curve, and the risk curve. And as I keep saying, the large cap at least look somewhat, sensibly valued. But as we go down the mid cap and small cap curve, things are looking pretty outrageously expensive over there. And I can give a number of examples, off camera, I really can't make head or tail of many of the stocks. So, but having said that, I don't know what's the trigger. I don't think one fine day every investor will wake up to the point that, oh, things are overvalued, let's start selling. There has to be some trigger which will result in, people's expectations changing to negative. I don't see any such trigger for the time being. Maybe it's not, I shouldn't probably, quote bad luck by saying that, but yeah, that's now doesn't look like there's anything on the horizon which would, give me sleepless nights, barring the valuation part.
Your view is that consumption is struggling, investment is booming, and you expect that consumption will gradually come back in next 2 to 4 quarters. So is it time to do the reverse, which is sell capital goods and buy rural facing companies, buy companies which right now are facing the heat of consumption slowdown? Because if that normalizes, investment will come down and consumption will go up.
I'm not sure investment will necessarily come down. I suspect, that story will continue, given the fact that, we are still in the very early stages of, let's say, a reasonably long investment cycle. If you look at the household or the residential investment cycle, they just started. We are 3 years into the cycle, and household residential real estate cycle is typically fairly long, I would say, at least 8, 9, 10 years. For equity is still good. There is still, fairly strong momentum as far as the cycle is concerned. So I don't think anything, suddenly changing the investment part of the story. Now, the more important part is whether consumption picks up, irrespective of whatever is happening on the investment side, and I would assume two things will play out as we go along. And both these are reversals of factors which have dampened consumption for the last 4, 5 quarters in a row now. So the first point is income growth, which has been a bit of a challenge for the low-income households as the investment cycle continues, more private sector, sector capex takes place. Hopefully, income levels start, moving somewhat in line with inflation, unlike last 4, 5 years, where at least for a section of the household, income growth has actually lagged inflation. And obviously, you had the challenges of COVID, also 2 years of fairly, low income for a section of the households. So that's number one. And number two and more relevant point is at some point in time, hopefully, prices start, becoming more stable and even coming down. If you look at the product prices, they have gone up significantly over the last 5 years in line with steep increase in raw material prices. So companies have been pretty, aggressive in raising prices, passed on most of the, or in fact more than the increase in raw material prices to the consumers. So you have added this, unfortunate situation where income growth has lagged the increase in product prices. Now that product prices are starting to stabilize, raw material prices have actually come down. Hopefully, product prices will come down. Maybe that's when the liquidity situation, which has got distorted significantly against consumption, hopefully that starts improving over the next 2, 3, 4 quarters. So that's the story. We expect some pickup in consumption as we go along. It's not something which will happen overnight, but it'll probably take some time
Okay.
to pick up.
okay, will take some time, but consumption is likely to pick up. And you were talking about the froth in the small cap sector, and incidentally, Kotak Mutual Fund has limited the subscription of units in Kotak Small Cap Fund as well. But just shifting focus, we discussed the risks to the market in detail. But what are the triggers lined up ahead? Because if you look at elections, that's pretty much factored in. Earnings is something which you're saying in your note has peaked out. In that context, what should be a realistic return expectation from the markets this year then?
We're not saying earnings are peaked out. What we're saying, profitability has peaked out. That is, margins have peaked out. Obviously, raw material prices have come off very sharply from the second quarter FY 2023, and margins have expanded quite significantly. So, over there, I would hope that volumes start picking up, because going forward, given the fact that the tailwind of margin expansion will no longer be there, at least from the first quarter FY 2025, the margin expansion story will probably get over. I think there's just one more quarter, I would say. If by that time volumes don't start picking up, then you would have this unfortunate situation of muted top line growth and muted bottom line growth. Unlike currently, where you're seeing muted top line growth, but very strong bottom line growth. Yeah. So, if that doesn't pick up, that itself becomes a concern for the market, given the fact that valuations are at fairly high levels. And if you don't see recovery in volumes, and profitability uh, seems like it's already peaked at fairly high levels. Unlikely it can expand further from current level. Then what? Then the profit growth is going to languish in that case. In that case, we'll probably see some downward revision to earnings. Multiples start looking even more expensive. Maybe that's when some correction takes place as far as some of these expensive consumption names are concerned. Beyond, I don't know, triggers, as we were discussing earlier, at some point in time, the US Fed will cut rates. March doesn't look like. Maybe in the May policy meeting, that's the first rate cut, followed by probably more in the second half, for whatever the number may be. But that seems to be a well-known fact. I don't know whether there's going to be any major negative or positive surprise over there. Elections is anyway looks like a done deal based on whatever survey results and political commentators are suggesting. No negative surprise over there too from a market perspective. So I don't know. It seems like a reasonably decent setup in the sense, everything looks good for the Indian market. And even in a global context, given China struggles on a relative basis in emerging markets, India again looks, pretty decent. Yeah. So beyond valuations, everything else looks quite okay, I would say, for this market.
Okay, we'll hold on to that. Sanjeev, great to have you on the show and join in with your thoughts. Thanks as always.